Nice to see you. Hi, this is Peter Casting here from StarTrader. I'm going to talk about inflation. Inflation's not exactly great fun, but it's relevant. I think we should talk about this so that we get a feel for what's going on. First of all, let me give you a bit of a background as to what we're doing here at StarTrader at the moment, what's going on our side. We currently serve 5 out of 8 billion people in the world. So we're currently present in markets where 5 out of 8 billion people in the world live. That's an incredible number. And it's great. If I would have shown you this chart 12 months ago, then Latin America would not have been on the chart, but Latin America is on the chart now. So it's really good growth, really good fun, and thank you for being with us on this journey. It's amazing. That's not what this presentation is all about. I'm going to go outside our core markets. I'm going to pop into the United States for a little while. And in the United States, we find the Silicon Valley Bank. And some of us have been wondering, okay, so what actually happened? There seems to have been some great disaster. So what is it really that happened? Well, it's not very simple. The starting point is complex, and it started some 10, 15 years ago, where governments worldwide did large quantitative easing programs. They continued for a long time. Large quantitative easing programs where they printed a lot of money in order to drive investment, in order to push investment high. But things didn't work precisely the way that it was intended. There were a couple of things that went a bit differently than one would have expected. And one of them was driven by the interest rates being historically low throughout that time period. The low interest rate meant that banks were able to use the quantitative easing money as security when providing loans using the low interest rate out into the market. And that meant that the amount of money that was actually moved into the market was much greater than simply the quantitative easing part. Incredible amount of money went out. And that money was so vast that it went into housing and shares to a greater extent than into investments as intended. Sure, investments got some of the money, but there's so much of it that a lot of it had to go into real estate and into stocks instead. Now, okay, so what's happening now? Well, the thing that's happening now is that a small percentage of that money is beginning to leak from housing and from shares into the things that make up consumer price index, meaning into the things that make up inflation. And even if it's only a small percentage of that money that's leaking across, the starting point is so big that inflation is popping. There's a lot of money that's moving in to things that drive inflation. And we see that worldwide. We see it everywhere. We see it in Thailand, where the central bank's goal is to have between 1% and 3% inflation. However, inflation's plus or minus around 5%. That doesn't sound too bad. However, if you look at markets like the UK, for instance, then the central bank goals are 2% of inflation, and the actual inflation is running plus or minus around 10%. Now, that's a vast difference, huge difference. So what should we expect central banks to do? Well, we've seen it already. There's nothing new. Central banks are increasing their interest rates. However, when they increase the interest rates, that kills off investment, and that cools the economy in ways that weren't quite intended. So, ouch, that's difficult. Quantitative easing and quantitative tightening are not the same thing in reverse. They're different. The effect of quantitative tightening is different compared to the effect of quantitative easing. And no one's done this before. So I'm definitely not critical of the central banks. It's just an incredibly difficult thing that's happening right now. Very, very, very difficult. So let's jump over into the Silicon Valley Bank for a moment. Well, the general picture is kind of the same. However, when you start looking at the detail, it's a little bit different because the business model that Silicon Valley had was a business model where they borrow money from depositors, and these depositors were typical Silicon Valley people. So big deposits from startup companies, from high-tech companies, rich individuals in that sector and so forth. So lots of big deposits coming in. And on the other side, what SVB did, or Silicon Valley Bank did, was to take some of that money and put it into long-term investments. So long 10-year things, 5-year things, where they could earn a trusted return on that money. And they could live from that difference. And everything was nice and safe. And they even bought some hedging products so that if the rate of inflation would go up, then they would still be safe. So everything was looking good in 2021. 189 billion in deposits in 2021, really nice, nice and steady, everyone feeling good. However, during 2022, a number of things went wrong. One of the things that went wrong was that the venture capital market for the types of startups who had deposited into Silicon Valley Bank, that market went difficult, which meant that a lot of companies were burning through their cash as planned and as projected. However, they were not adding new investments into their businesses, which means that the size of the deposit went down. At the same time, the rate of interest went up, which means that the face value of the long-term bonds that Silicon Valley Bank held went down. So that caused a whole bunch of difficulties for the Silicon Valley Bank. And they responded. They responded by selling the hedge products that they had. They did that mainly in the first half of 2022. However, it wasn't until the 8th of March, just in the evening, post-close, 8th of March, that they revealed what they had done. So post-close on the 8th of March, they did two things. One was they asked for big new additional investments into the company, the capital raise. And the other thing they did was to reveal that 12 months earlier, they had sold a lot of the hedging products that would protect them against interest rate rises. And in so doing, they lost $1.8 billion. Now, that doesn't sound good at all. So really not good. When the 9th of March came along, Thursday, people ran. People started swiping out money from the bank. Big amounts of money disappeared out of the bank during just one day. Literally tens of billions of dollars were swiped away with apps into other places. There was a run on the bank, big time. So what they did then was to say, okay, tell you what, we're not going to do this capital raise. We're going to do something else instead. So they tried to work out plan B very, very quickly. Of course, they had now disclosed that they lost lots of money on the hedging products. That kind of makes it awkward. And on Friday the 10th, everything went south. First, the stock price went down by 60% on one day, then it went down by 69% again the next day. Wow, huge losses for everyone. And in the afternoon of the 10th of March, the receivers were appointed and Silicon Valley Bank was dead. Well, not dead. It goes into receivership, and it'll come back in some shape, either by people buying chunks from it, as HSBC has done in the UK, or something else. There is still money in there, but it's not pretty. So incredibly quick, and ultimately caused by not being able to handle the way that the interest rate rises from the central banks can hit a bank. These are difficult things. So my conclusion from this is that, yes, there is money in 2023. There's plenty of money in 2023 in the marketplace. The main reason being that banks simply don't know how, or central banks simply don't know how to take back the money that's already out there. It's very unfashionable to talk about the amount of money, absolute money, that's in the marketplace. People prefer to talk about things like inflation and so forth and so forth. But it is true that there's a lot of money that's still hanging out there since the quantitative easing days. And it is true that it's not easy to do quantitative tightening to bring that money back. So, hey, there's a lot of money in the marketplace. There's a lot of volatility. That volatility will continue, I think. Let's see. I don't know, but we'll see. And in summary, from a trader's perspective, this is a dream scenario. There is money and there is volatility. That could not be better. That's simply a wonderful thing. Additionally, there's more money coming in because the COVID restrictions in China are now easing up, which means that a lot of people are coming out of China as tourists and so forth. And if you look at the countries to which that tourism goes, and if you look at what leaves China, there's a big mismatch in the number of dollars that countries receive and the number of renminbi that people leave with. And that mismatch suggests, according to research that was released in February, suggests that there's a big outflow of net money out of China into markets. So there's more money coming in from that side as well. So yeah, it's a fascinating market we live in right now. It is really moving. So in summary, join us now. I think 2023 and 2024 might very well turn out to be the biggest years in trading ever. Thank you, everyone. I really appreciate you taking the time to listen to this.